Hey traders, I want to introduce you to one of my all-time favorite trading strategies. I call it the bear market trading strategy. I think it's perfectly positioned for today's current market environment, and it's got one heck of a ridiculously successful track record. All right, so let's get into this. This is the bear market trading strategy, and I want to talk about a couple of aspects of this in this video. I want to talk about the whole premise, the whole idea behind the trading strategy, where it came from, how it's evolved, what our thought process was about 3 years ago now when we put this together. Go into the research and the analyses. I think that you're going to see some things that you've maybe never used before in researching trades and looking for trade ideas. I want to show you the trade structure. I don't say that it's proprietary in nature. Other people can and have done this type of trading setup, but it's going to be unique. It's going to be something that you've probably not done before. And then I want to finally, last but not least, go through the audited results over the last 3 years. And I think you'll be blown away by the success of this program. So let's start with the premise of the trade. This is interesting. This was sort of an idea that we generated about 3 years ago or so with my research team and my trading buddies. And the idea was simply, could we find trading opportunities to the downside? Now, there's a whole lot of ideas sort of baked into this, but I will just tell you that personally as a trader, going on almost 35 years now of trading the markets, I love to find opportunities to the downside. I love trading opportunities to the downside. And there's probably 4 things that I think stand out to me in today's marketplace that make this a really sort of, in my mind at least, a go-to trade. Okay. Number one is that if we are looking to trade bear market strategies, if we're looking to trade opportunities or find situations to make money to the downside, I will just tell you from a research standpoint, it's much easier to find a crappy stock than it is to find a diamond in the rough, to find a gem. See, we are all conditioned, we're all patterned to try to find the next Google, the next Amazon, the next Microsoft, the next Tesla. We're looking for these needles in a haystack to try to, get in at 10 and get out at 50. And that's great and it's wonderful, but it's a very, very hard row to hoe. It's very difficult to find stocks that are going to double and triple. They are few and far between. They're always in the news, but in terms of looking at the 14,000 things that are trading on the U.S. exchanges on a daily basis and trying to find the 5 or the 10 that are going to double or triple, it's kind of tough, right? But it's much easier to find companies that are in trouble. It's much easier to find companies that are weak. It's very, very easy to analyze companies and find companies that have been perennially losing money quarter after quarter, year after year, and have the threat of bankruptcy looming over their head. So the first premise, I guess, is that when you are searching and sorting through these 14,000 underlines trading on the U.S. markets every day, trying to find a trading opportunity, it's going to be much easier to find weak companies, crappy companies, than it is to find companies that are amazing and can potentially double in value, right? So number one, I think it's easier to find companies that are potentially downward movers than it is to find companies that are upward movers. Number two on the premise here is that I feel like there is greater potential. There's greater potential to the downside. If you were to say to me, listen, I want to set up a filter and a search and a sort process with some software to find trading ideas that only have the potential to go up in value by 50%, right? I only want to look for companies that can go up by 50%. If it's a $10 stock, it has to be able to go to 15 as a viable potential for me to even be interested in that. Well, again, very hard row to hoe, very difficult to be able to do that. But yet, if you want to invert that and say, okay, I want to find companies that are in trouble, companies that are perennially losing money, companies that are going to have to go through a restructuring or have some catalyst take effect soon, and I am looking for opportunities where the stock can drop by half, right? That $10 stock can drop to 5. Well, those are much easier to find. So I think that there is greater potential. Stocks tend to move down with much greater velocity, much greater speed than they do to the upside. So I think it's just a lot more potential to the downside than there is to the upside. The third premise that I always make is that there is less chance of loss. There is actually less risk. And the reason that I say that is that when you talk to people and you say, how's it going in the market? And again, they're traders. These are not passive buy and hold people that are just throwing money in their 401k and looking at it once a year. These are traders, and they say, I just lost X amount of money, or I just had a bad trade, or this just went against me. And you ask them, well, what happened? Rarely do they say the stock jumped up 50%, right? Usually it is, well, the stock fell 50%. Whatever I was in, whatever I was invested in went down. Guys, I think that here at all-time highs, essentially all-time highs of the marketplace, as I sit here at the end of April of 2021, recording this, that there is a greater propensity to go down than up in this marketplace. And so there's probably less chance of getting hurt in a bearish trade right now than in a bullish trade. Bullish trades, there's a lot more downside, I think, than there is upside. And then last but not least is that asymmetric aspect of that. Guys, for all intents and purposes, right now as I record this video, this is the end of April 2021, the markets are bouncing off of all-time highs. Now, that doesn't mean that they can't go higher. In fact, everything right now that we are looking at from a technical standpoint in this marketplace, as well as a fundamental standpoint, points to the idea that the market is probably going to continue to go higher because there's a lot of strong fundamentals as the economy reopens after this pandemic. But we're at all-time highs. And so from an asymmetric standpoint, I think we have more potential down than up. I don't think that we are going to get the market this month, for example, of April, up almost 5-6% on the month. Annualize that out. Do you think that is a real sustainable result? Do you really think that the market is going to make us 60, 70, 80% a year rates of return? Probably not. This rate of growth in the market probably not going to continue. And so I think from a risk standpoint, it actually behooves us to be safer by trading to the downside. So that's the whole premise of this program. Let's get into the research and analyses phase because I think you're going to find some interesting things that we do in this program. Okay, so like I said, I think the research that you're going to see that I do here, again, it's not necessarily proprietary in nature, but it's probably something that you haven't seen in the past and maybe a little bit different approach to analyzing trading ideas. So there's a couple of things that I use in running these scans to try to find opportunities to the downside. The first one is the Z-score. We're looking for a Altman Z-score between 2.5 and 3.7. So we'll get into what the Z-score is and who the heck Edward Altman was and what that number means. We look up for opportunities with a market cap greater than $3 billion. We want something that has room to fall to the downside and hasn't already, gone through a huge bear market move. We want to look for prices above $10 a share so that, again, there is still some downside potential left in the opportunity. We want to exclude biotech out of it because biotech numbers are always ugly. There are a lot of R&D in those companies, and cash flow and earnings are not always what drive those stocks. And we want the closing price to be below the 10-day simple moving average. And then we're also looking at using StarMine's probability of default mathematical model. It's Ekin's proprietary scoring system that they use, and we'll get into that as well. So let's look at each one of these individually here, and we can get an idea of what we are looking at. So let's talk about each one of these individually. Z-scores between 2.5 and 3.7. So there's an individual, he was a NYU finance professor named Edward Altman, came up with what's called the Altman Z-score, and it's simply a way to calculate what the probability of a company going bankrupt is. And there's the score right there. There's the actual calculation that you can look at that he uses. Working capital versus total assets, retained earnings versus total assets. Earnings before interest and tax by total assets, market value of the equity versus total liabilities, and then sales versus total assets. And he uses these scores to calculate or determine whether a company is headed for bankruptcy. And the formula, it looks at all of those things. It looks at profitability, it looks at leverage, liquidity, solvency, activity ratios, all of those things. So an Altman Z-score that is close to 1.8 suggests that a company is probably headed for bankruptcy, whereas if the score is closer to 3, the company is in solid financial positioning. So we're looking for Z-scores between 2.5 and 3.7. That's on the lower end of the scale, but it's not down in the 1.8 to 2 range where the company is already in trouble and has probably already collapsed from a stock price. So we use the Altman Z-score. Very, very powerful tool. It has tremendous predictability in it. It's quite accurate. So again, we're looking for that Z-score in the 2.5 to 3.7 range. Market cap greater than $3 billion. So we want companies that are still large. One of the challenges when you start to screen and scan for quote-unquote weak companies is the fact that you generally pull up weak companies, and these are companies that have already collapsed in their price value. And so we do want to look for companies that have a price that is still above $10 a share, market cap greater than $3 billion. We do exclude biotechs because they always look ugly on their earnings and sales front. Sometimes a lot of them are just R&D companies. And we want a trigger. We want a trigger that indicates that we are headed down lower. And so we do look for opportunities where the closing price is below the 10-day simple moving average. And then in addition to that, we use StarMine's probability of default. Now, I'm not going to go through the whole concept behind SCR. They call it the structural credit risk model. But it is basically a framework put together by Robert Merton, and it models a company's equity on versus assets and the probability of default. And they score that on a percentile basis, and it's looking at trying to find opportunities where we can get a 90% probability of success declaring a default potential within a 12-month time horizon. A lot of people like this model, the StarMine model, better than the Altman Z-score. We use both of them though. And so in addition to that, of course, we have to structure the trade correctly. So that's our research. Let's go ahead and look at the trade structure. All right, let's take a look at a opportunity here that meets our criteria. It meets our analyses, and that's Yum. Now, again, this is April the 27th, 2021. This is a Tuesday that I'm doing this. And again, it meets our criteria. The Z-score is where we want it to be. The cap rates are all where we want it to be. breaking down. Trend is to the downside. It is a little bit overextended. I don't have my technical indicators on the chart here, but it's overextended here to the upside, breaking down below that 10-day moving average. So everything looks just exactly as we would want it to look for our analyses to meet the criteria for a downward potential trade. So how could you trade this to the downside? Let's say that you look at Yum and you say, yeah, it looks weak, and I think that it has more downside than upside in this thing. Well, one of the things that we could obviously go do is just short the stock, right? Now, I'm going to use an example here of just one share. It doesn't really matter how many shares we use, but we can look at it in a risk graph as an example, and it'll give us an idea of what that would look like if we shorted stock. So this is a pretty straightforward risk graph, right? We obviously know what a risk graph looks like when we buy a stock, and this one would be when we are shorting a stock. So again, whether it's one share or a million shares doesn't really matter. The risk graph is going to look the same. And if we look at some of the parameters on this, you can see that there's some pros and some cons. Now, again, I like shorting stock. I have stock short in my portfolio right now as we speak. And so it is a trade that I like. It's a trade that I deploy quite often. And, it's no different than any other trade. There's pros and cons to every single trade. There is no one panacea type trade. And some of the challenges that you see here when we short a stock is that, your probability of profit, your probability of success or being right, well, statistically, it's 50%, right? And it doesn't change if we were to go buy the stock. It's still 50%. It's a coin toss, right? When you buy or short something, hey, you got a 50-50 chance of being correct in your assumption. It's either going to go up or down. That's the only two things the stock's going to do. So, from a probability standpoint, look, it's not horrible. There's trades that are much worse than this, but that's not great. It's going to be a tough row to hoe if we are trying to build a trading strategy around something that works only 50% of the time. So that's a little bit of a challenge. Now, the other issues, of course, that we have, statistically, the max loss, well, it's infinite. It's undefined, right? Is it really an unlimited loss? Well, no, but technically speaking, Yum could go up and up and up and up and up, and we don't have any defined risk parameters up here to protect us against that. So while it has a lot of downside potential, it also has a lot of upside risk as well, right? And the reality is also, where's Yum going to go? Are they going to go bankrupt? Well, probably not in the time frame that I'm going to hold them. Maybe they do in the future. But, I'm a short-term trader. I'm usually in and out of trades within a 30-day period of time at most. And so I definitely don't think that Yum is going to go bankrupt in the next month. So is that really, all that good profit potential down here? Probably not. Probably not. So again, a little bit of a challenge if we were to short the stock. Well, what about if instead of shorting the stock, we were able to, let's say, go purchase a put option. And let's go out maybe, let's go out for a month in time. Let's go out 31 days here to the May 28th expiration date. And let's look at the chart here and let's say, okay, I think that maybe it's going to come back down to this consolidation range here, maybe around the 108 level. We're at 115 now. So let's maybe split the difference and I will purchase this 110 strike price put. Okay, mid price right now is $1.47. You times that by 100, that's $147 for that option. And we know what that would now look like in the risk graph. Now, options gives us quite a bit of leverage, right? So this is a $147 investment that I would be making. But my goodness, if we did fall down to the 90 level, that $147. It grows to almost $1,800, right? And of course, that's what's enticing about buying options. But there's some challenges with that as well. So a couple of challenges that you can see if we bought the 110 put option, we really would need the stock to come all the way down to this kind of 107 level for us to even really be in the money, be in the green, start making a profit. Well, 107, that's a decent way away from where we're at right now, which is about 116. So why the difference? Well, we have to cover the price of the option that we purchased, right? So that's one of the challenges. And because of that, because we have to overcome the price of the option that we purchased, because we need that big entire move from here to here just to even get into the profit zone, you can see that our probability of success gets to be pretty low. Nice profit potential out here, but low probability of success. Just a 22% chance of this thing actually working out. So, this is what people get excited about, right? Hey, I'm only putting up $147 and I could make almost $11,000 back. Well, A, there's a low probability of that happening, and B, you'd have to have your stock go all the way down to zero, which that's probably not going to happen either. So, probably not the best way to go. Now, what about if we said, listen, I still like the downside potential of this. I think that that's where the next move is going to be, but I want to improve my chances of success with this. And one of the ways that I could do that is by not being so greedy. I could simply say, look, I don't need all of this downside profit potential. I don't need it. I'm willing to give away some of this, $11,000 of profit potential. I mean, my goodness, I would be thrilled if I could turn $147 into $1,000. That would be great, right? So I'm going to be willing to give up some of the downside here in order to maybe mitigate my risk and improve my chances of success. Well, how could we do that? Well, we could cap this. We could come back in here and say, yeah, I'm going to go buy this 110 strike price put, but you know what? I'm going to turn right around behind it and I'm going to sell this 108. And you see now that my cost almost goes to zero on this trade. Now, we would have to work this order here. I don't think that that's an accurate mid price here because you can see the massive spread here. But you get the idea that we basically take away our the cost of the trade, probability of success shoots up. But when we look at that trade now in the risk graph, you can see why that is. We have now capped our profit potential on this trade. We still need to get down below that kind of that 107, 108 level, but once we do, we're in the money and we've capped our profit at a couple $100, which still is an amazing potential rate of return, right? So we want to get maybe even a little bit better than this. And so this is the formula that we use to set up these trades. So here's the setup we use, okay? I'm going to come in here on these 31-day out options. This is May 28th expiration date. And I am going to make that bearish trade. I'm going to say, okay, number one, I'm going to buy one of these 108 strike price puts. It's mid price about $1.17, about $100. We know what that looks like in the risk curve. I'm going to cap my profit potential down here on this by by selling the 106 strike price puts just down below that. And that takes my cost, if we can remove that leg, you can see that it takes my cost from about that $1.17 or that $117, and it really mitigates it. It really takes it down to just about half that, about $60. So a lot less risk in the trade because I am, of course, now capping my profit potential. But what would be even more exciting to me is if I could make this a much higher probability of success trade, something much better than, say, just 17% success rate potential. And I'd like to also get away with that cost. Even though it's only a $60 cost, I'd like to get away from that. So what we're going to do here, I'm going to come back into my table and I'm going to do a ratio trade. I'm going to sell a call credit spread at a ratio of 7 to 1 here. So this is a debit spread. I'm going to now, on the put side, I'm going to now sell a call credit spread in a ratio trade at a ratio of 7 to 1. And the ratio is going to be up here around 120. I'm going to sell the 120s. I'm going to buy back the 122s. And then I need to highlight these. You'll notice right now it's not a ratio. It's 1 to 1 right now. I'm going to highlight this. And I'm going to change that to 7 contracts. Now, what does that do to my trade? Well, you can see it's about an $1,100 trade. It's got a max profit of about $469, but now the probability of success pushes up almost to 70%, 75% probability of getting about half of the profit potential of this trade. And now if we look at this trade in the risk graph, you see some interesting things. So here's our trade in the risk graph. Again, you can see we're putting up about $1,100, have about $469 of maximum profit, and that maximum profit kicks in down below $106 a share. Okay, so again, if we pull out just a little bit here, you can see the overview here on the risk graph. Let's go right there, and we can get a little bit better idea of, there we go, right in there. So you can see that anywhere in this area right here, we have a theoretical profit and loss of almost $600, and it shoots up to almost $800 down here on the, if we go below that 107 level. So lots of bonuses in this trade. We're up to almost 70% probability of success, almost 80% probability of some profit kicking in on this trade, and that's all obviously a lot better than where we were at before. And then a little kicker in here, right here, that we could make some extra money if we fall below that 107 level. So this is the trade structure that we look for as we set these trades up. We're doing a ratio trade. There are always going to be more calls than puts. B, we are you got to make sure that we are doing it in the correct manner. We are doing a debit put spread on the downside, and we are doing a credit call spread on the upside. And in essence, the income from the credit call side is paying for all of the risk of the debit put spread on the downside. So that even if we don't get down in this area, it doesn't matter. We'll still be okay. So again, we're doing it in a ratio, and so this is what's called a complex option combination. Most brokers are going to require that you do this trade in 2 separate transactions, that you do the puts in one transaction and that you do the calls in a separate transaction. So that's fine. At the end of the day, it's still going to combine to give you this profit and loss risk graph. It's still going to come in at about the same mid price, but we'll just have to execute them in 2 separate trades. So there you go, guys. There's an overview of the system. Let's look at the results of how this has worked out for us over the past. So let's go back here to our audited results. This is 2019 is when we started this process and this analyses and program. These are the actual audited trades that we have done, the annualized rates of return, how long we have held those trades. Let's go ahead and let's take a look at some of those results. This is 2019. You can see that we had 9 winning trades, 2 losing trades, 11 total trades, 82% win rate, and I don't know what our average annualized return was, but the thing that is impressive here is not just the win rate, which is very impressive, but the actual annualized returns on these trades. They are really, really something that has surprised us, to be honest, in this program. We thought we'd be clicking in maybe around 30-40% of your potential. These are obviously a lot better than that. But 2019 was an awesome, awesome year for it. So 82% win rate with about 79% annualized rate of return for the year. For 2020, our closed trades right here, you can see all of the trades that we've done here. I'll try to page slowly through these. You can see we had 1, 2, Almost don't even count that CarMax one, but we need to, from an accounting standpoint, count it as a loss, $11 loss. So 1, 2, 3, and then the win trade here, you see we adjusted that from an initial loss to an actual profit of $598. So 3 trades during the year of 2020 that did not work out, and about 167% annualized rates of return. And if we look at the trades 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. Looks like about 24 trades that we took during the year with 3 not working out. Pretty amazing success rate if you look at it. And again, about 167.56% annualized rates of return on those. Again, one trade here that we adjusted our way out of a loss into a nice overall profit. So 2020, absolutely gangbusters. You can see the trades that we've done so far in 2021 that are closed trades. Same sort of scenario here where we had one trade with Charles Schwab that we ended up needing to adjust as well. You can see the adjustments down in here. Ended up adjusting that into about a $202 profit on the trade. So knock on wood, 1, 2, 3, 4, 5, 6, 7 trades so far into the year of 2021. Not a single losing trade. Not one single losing trade. And batting about 125% annualized rate of return on these when you start to average them out. So just absolutely gangbusters results on this system, and absolutely thrilled with not just the consistency of the trades, but the rate of return is just through the roof as well. So this is, again, guys, our bear market trading strategy.